Welcome. I'm worried that the Federal Reserve has created a third pillar of monetary policy, that of a stable and rising stock market. And I say that because then Chairman Bernanke, when he appeared here, stated repeatedly that the goal of QE was to increase asset prices like the stock market to create a wealth effect. So that seemed as though that was a goal. It would stand to reason then that in deciding to raise rates and reduce the Fed's QE balance sheet, standing at a still record $4.5 trillion, one would have to be prepared to accept the opposite result: a declining stock market and a slight deflation of the asset bubble that QE created. Yet every time in the past 3 years when there has been a hint of raising rates and the stock market has declined accordingly, the Fed has cited stock market volatility as one of the reasons to stay the course and hold rates at zero. So indeed, the Fed has backed away so many times from rate normalization that, and I think this is a conceptual problem here, that the market now expects stock market volatility to diminish the odds of a rate increase. So, Madam Chair, is having a stable and rising stock market a third pillar of the Federal Reserve's monetary policy? If I go back to what I originally heard Ben Bernanke articulate.
It is not a third pillar of monetary policy.
Right.
We do not target the level of stock prices. That is not an appropriate thing for us to do.
And I thought you would say that. So the question I have as a follow-up is, does that mean that you're prepared to accept stock market volatility or a slight deflating of the asset bubbles as the Fed proceeds toward normalization?
We're going to look at what the trajectory is for the economy, for the goals Congress has assigned us, namely inflation and maximum employment, and take policies we think are appropriate to foster them. Now, as the economy recovers, we have said we anticipate raising rates. What implications that may have for stock prices. Right. One shouldn't assume that it will necessarily be a negative scenario for stock prices.
Right.
Higher rates, to some extent, are already built into longer-term interest rates. Longer-term interest rates are anticipating a path of rising short-term rates. They do matter to stock market valuations, but so do earnings, and in a strong growth economy. But whatever, yeah, we're not targeting equity prices. We're trying to achieve outcomes for the economy.
And then there's another aspect of this that I wanted to ask you. This is my last question. In September of 2015, you were asked whether you were worried that given the global interconnectedness, the low inflation globally.
The low inflation what?
Globally, yeah, that we were seeing. Were you worried that you may never escape from this zero lower bound situation? And you answered at the time, while you couldn't completely rule it out, that is not the way that you see the outlook or the way the committee sees the outlook, okay? Since that time, in February, Governor Brainerd suggested that financial tightening associated with cross-border spillovers may be limiting the extent to which U.S. policy diverges from major economies. New York Fed President Bill Dudley has said that global consequences can impact the monetary policy transmission mechanism in the U.S. and influence the effectiveness of our monetary policy in achieving our objectives. So my question then is restating the question from last year, not will we never escape, but will we escape anytime soon? And maybe to put it more clearly, does the Fed have the capacity to defy the global pattern of zero or negative rates if That's the global reality.
We do have the capacity to have different rates than the rest of the world, but we have to recognize that differentials in our stance of policy impact, for example, the value of the dollar, and that is a linkage back to the U.S. economy. So those linkages, as my colleague said, are important, but the bottom line isn't, and what happens in the rest of the world and their stance of policy, it does matter, but it doesn't mean we can never escape.
The time of the
raise
gentleman from
Thank you,
California
Chair.
has expired. The chair now recognizes the